Welcome to your market brief for the week of February 3rd. I'm Caroline Woods. As coronavirus fears grow throughout the world, Chinese markets opened the week in the red following the extended Lunar New Year holiday. For more, we're joined by Mark Decambre, MarketWatch's markets editor. Hey there, Mark. Great to have you back.
Good to be here, Caroline.
All right. So in China, stocks plummeted. In Europe, they're pretty flat post-Brexit. Here in the U.S., it looks like their futures are attempting to claw their way back into positive territory. What's your take on the week ahead? Was this just a short-term jolt amid stretched valuations?
I mean, certainly there's been a lot of talk about valuations, and that's part of the issue here. I think on Friday we saw a pretty big drop-off, a sharp drop-off for the Dow and the rest of the U.S. stock indexes. So today's move, I'm not sure what it signifies. We'll see how it plays out for the rest of the day. It would be nice to get a solid gain throughout 4 p.m. at the close to see where things stand. But you know, it's better to be up than to be down. But we had a big plunge in China markets, which is to be expected to some extent because they've been closed for the past week or so, since January 24th. So they're reacting relatively a week's worth of downturn. So they've got to be repriced. All the stocks there have to be repriced to reflect this coronavirus issue.
And speaking of plunges, we've seen a big plunge in the oil markets. What do you make of that? Is that something you think we can recover from, or is it something even bigger than the coronavirus?
I mean, that remains to be seen as well. But we've got for crude oil markets, there's an issue about demand, and with the coronavirus hitting the world's second largest economy, and we're seeing travel restrictions, certain airlines. We're seeing the expectation that we might see a hit in China's economy. China is one of the biggest importers of crude oil, so that there's that issue. There's also an issue of fears of oversupply, and U.S. shale producers are a big feature in that, producing a lot of oil and raising some concerns about whether or not that's going to be taken up by the rest of the world. So coronavirus didn't help.
So we have coronavirus, we have an upcoming presidential election where we don't know the results yet. We have still geopolitical tensions in the mix. Do we have to now add recession fears back into the concerns list based on the inverted yield curve? What's your take on that?
I mean, certainly we had some brief inversions of the yield curve at the 3-month and 10-year level. And basically an inversion is where you have the shorter term debt rising above the longer term debt, which isn't a normal feature. So when that happens, as you point out, it can be a recession indicator. This time around, folks are talking more about the impact of coronavirus and exogenous factors and the uncertainty that this Asian influenza brings, more so than expecting that there's going to be a recession in the near term, at least.
All right, so the Fed obviously played a big part in 2019's rally. What does all of this mean for the Fed and already easy monetary policy?
Well, I mean, we'll see how things play out. We had the Fed hold fire last meeting, so the expectation is that they're going to continue to remain accommodative, which is good for markets. But there's still some uncertainty about how this Asian influenza plays out, how the coronavirus impacts China, how it impacts China's economy, which is already slowing, and how that ripples to the U.S. and other countries, if at all. So you've got some uncertainty there. That, in theory, should keep the Fed accommodative, and easy money should flow a little bit more. But there's a point at which that becomes problematic for investors because if the Fed is continuing to be too easy, you got to worry, what does the Fed know that I don't? So there's always that concern about how the central bank thinks about the economy.
So in short, uncertainty seems to be the name of the game. We have to leave it there, but thanks so much for joining us, Mark. Appreciate your insights.
Thanks for having me.
Shifting to a quick look at the week ahead on the campaign trail, the Iowa caucuses will get underway as Democrats cast their vote in the party's race to determine the nominee who will face President Trump in November. In Washington, President Trump is scheduled to deliver his State of the Union address on Tuesday, and a vote in the impeachment trial of the president is expected on Wednesday. On the economic calendar this week, we'll get a read on the services sector for January on Wednesday. We'll also get data productivity and labor costs for the fourth quarter on Thursday, and the January U.S. jobs report is due out on Friday. And we have another packed earnings calendar with Alphabet reporting on Monday, ConocoPhillips and Disney on Tuesday, General Motors and Merck on Wednesday, and Uber, Twitter, and the parent of Dunkin' Donuts on Thursday. With earnings in mind, it was a strong fourth quarter for Tesla. Following last week's beat on the top and bottom line, shares gained 12% through the end of Friday's session. Helping to spin this news forward is Cathie Wood, who serves as founder, CEO, and CIO of Ark Invest, where she oversees $11 billion. Cathie, thanks so much for being here.
Oh, pleasure, Caroline.
I want to get right to this price target for Tesla. You recently came out with a price target of $7,000 by 2024 for Tesla. What's going to get Tesla there? What's behind that future growth?
Well, the starting point is that the price of an electric vehicle is going to drop below the price of a gas-powered vehicle, like for like, within the next 18 months to 2 years, and then will continue to fall. So it's going to be a no-brainer. Electric cars are going to be cheaper, and they're better cars. They're better cars. So that's the beginning. We see electric vehicle sales going from 2 million units last year to roughly 37 million units in 5 years, accounting for roughly a third of total auto sales in 5 years.
So is that what needs to happen next? Because I guess what needs to happen in order for you to say, yes, we were right, Tesla is heading there? Or if you are wrong, what would need to happen that would be your mistake, I guess, or Tesla's mistake?
Well, actually, if we're going to be wrong on that 37 million units, it's not because of Tesla. We think Tesla's share will stabilize around 18% if other auto manufacturers are able to ramp. If they're not able to ramp, then Tesla's share will be higher than that 18%. So we're not as much worried about Tesla when it comes to that forecast. We're more concerned that other auto manufacturers really haven't even gotten started in this game.
So I guess it would make sense then that you're not that concerned about Tesla, that your bearish case is still Tesla at $1,500 a share, which is still more than double where it is now. So, I mean, you're pretty bullish all around.
We're pretty bullish. So that bear case assumes nothing for autonomous. If they get anything right on autonomous, and we think they already are, they have more miles of real-world data collected for this AI project than any other auto manufacturer or technology company in the world. So we think that 1,500 is a minimum expectation.
So it's very clear based on the price target and your talk of AI that you look at Tesla as more of a tech company versus an automaker. But come 2024, in 4 years, what kind of company will Tesla be?
Well, it's going to be a transportation as a service company. We believe it will launch one of the biggest autonomous taxi networks in the world, here in the United States to begin. And it will start even before that. On its conference call last week, Elon was asked, will you start a ride-hailing service with human drivers first in Tesla cars? And he said, yeah, that would make a lot of sense. So that's probably going to happen this year. But we do believe that autonomous will launch within 2 years here in the United States, and that Tesla will lead the charge, so to speak.
So what's your strategy then in terms of ownership? Because obviously Tesla saw a big run up last week, as we said, post earnings, but $6.50 a share is a bargain compared to $7,000 or compared to $15,000, which is your bull case.
Yes.
So what's your strategy in terms of ownership? Are you buying now?
So in most of our portfolios, we are limited to buying up to 10%. And so what we've been doing is actually taking profits to keep the position around 10%. Now, that will give us the psychological wherewithal also, if there is a correction, to buy if it drops below a 10% holding.
All right, we have to leave it there. Cathie, thanks so much for
Thank you,
joining
Caroline.
us.
Thank you.
Before we go, Barron's wants to recognize people and programs that are making an impact to improve the financial health of individuals across the U.S. For more information and to submit nominations, head to barrons.com/celebrates. And lastly, you voted on who you trust most with your data, with choices of Amazon, Google, Apple, and the U.S. government. There was an overwhelming preference, with 65% voting for Apple as the winner. That concludes today's Market Brief, but we want to hear from you. Comment below and tell us if you think a correction is coming this quarter. I'm Caroline Woods. Thanks so much for watching.